Hi, everybody. This is Dan Sheridan at Sheridan Risk Management, and I want to talk about the wheel strategy. Here's the traditional wheel strategy, and this is what's out there. I think it's a great strategy. Um, and for those of you not familiar with the traditional wheel, um, it's basically this process of buying low, selling high. So you start out selling puts. I guess it'd be cash secured puts, but you're selling naked puts. Um, and you collect the premium. As long as the stock doesn't go down that much, you just collect the premium. And many people do this, right? Well, Michael Dell, Warren Buffett, it's a very popular strategy. And the idea with the traditional wheel is you sell puts in stocks you like, and then if the stock goes down, you have a mechanism in place to buy stock at a lower price. If you get assigned on the short puts, then you get long stock. You can sell calls against the stock as it's going up. You sell out of the money calls. And then if you're assigned on the short calls, your stock gets called away because you get your short calls turn into short stock and that negates your long stock. And then you could restart the whole process. And so you sell puts, stock goes down, you're buying stock at a lower price, stock goes up, you're selling calls, and stock gets called away at a higher price, and then you restart. So it's kind of like the buying low, selling high, and very popular out there. I've always been concerned about with the traditional wheel, two things that uh, I thought I would have liked a little bit better. Number one, it costs a lot of money. If you have a $400 or $500 stock like Microsoft, so it costs 40 grand to buy the stock. So for smaller accounts, what could you do? And do you want to tie up that money? And the other thing with tying up that kind of money, your yields go down. So the two main problems with the traditional wheel, it takes a lot of capital and your yields are pretty low. So I thought, well, what could be, how can we tweak this? And so I developed the all wheel option strategy. I haven't seen anything like this before, just making a couple tweaks to it. So if you look at up here, and I'll have another slide with a little more detail, I'd sell a put credit spread, right? Which we'll get to in a second, but replacing two main replacements, replacing the expensive short put with a much cheaper, better yields, sell a put credit spread, vertical put credit spread. You could call it a bull put spread. Then as you go through the cycle here, if you get assigned on the short put of the credit spread, you could, okay, what happens? You get assigned on the short put of the credit spread, your long stock. You could sell it out, right? And then replace it with an in the money call. Or, which would be much easier, as you get near expiration and the extrinsic value dissipates of the short put, you just buy it back in. And then buy an in the money call, which is going to be a really cheap surrogate for the stock. So two changes. Instead of the short put, you're doing the short put spread. Instead of having long stock, you buy an in the money call. And then some of them are pretty similar. After that, you sell calls against the in the money call versus the traditional wheel was long stock. Then if assigned with the traditional wheel, closes out your entire position. Whereas with this, very similar to the previous step, where if your short calls are getting near, if you want them to get near assignment, as you get close to expiration and the extrinsic value disappears of the short call, you just buy them in and sell out your in the money call. And here is a slide with a little more detail. Step one, and we just come up with a course on this. You could check it out at SheridanRiskManagement.com. But on step one, we can sell put spreads. We call that income collection. And you could just park in step one and do narrow spreads. Or you could follow the wheel and do wider put credit spreads. And I'll illustrate that more in the course. But that, you could park here, or if you want to go along the wheel, a wider put credit spread is much better yield than the short put. And then at step two, if you're assigned on the put, you could just sell the stock and replace it with a long in the money call. Or what I would recommend, just again, as you get near expiration and the extrinsic value disappears, you could just buy in the short put, replace it with the in the money call. And then step four, you have a couple choices. You can sell an in the money, at the money, or out of the money call versus your long in the money calls, depending on your short-term opinion in the market. Obviously, this is a strategy where you're longer term bullish on a stock or the market. But that doesn't mean over a 3-week period, if you're selling calls every 2 weeks, every week, every 3 weeks, depending on the market or your stock, you may want a little more protection. So sometimes you might sell an in the money, and at the money, or the out of the money. But you can also, if you're more bullish, in addition to selling an out of the money call, you can sell a put spread against it. I mean, this would be similar to what people have done in the past where they're long stock and they sell an out of the money call and an out of the money put. But again, the whole idea here is to keep the capital low and the yields soar much more than potentially than a traditional yield wheel. Again, you can stay at step four, just like you can stay parked at step one. If you want to, as the calls, if you're selling a 20 delta or 30 delta, and it gets in the money up near a 70 delta in your graph is leveling out on the upside, you can just roll it out to a higher strike. But if you want to continue the wheel formation, you could just let your short call, let the stock, as the stock rises and your short call gets in the money, as you get near expiration and the extrinsic value disappears, you just buy it in and then sell out your in the money call, and then just go on to step 6. So I'm excited about this. Again, it offers a much better yield than the traditional wheel, much less capital, and similar performance though, because so again, we should have that out soon at Sheridan Risk Management, and there will be examples in there, and you could go through that. So thanks everybody. Have a nice weekend. Thank you.